Hi everyone, this is Arpad from StarPath Academy. Today I have the pleasure to talk to Jason Hartman. Jason is a real estate investor, educator, and an author. He runs the YouTube channel Jason Hartman and educates people about the economy and creating wealth with real estate investing. Jason, it's a great pleasure to have you on the show. I have been following your channel for quite some time now, and I always find your presentation interesting. I invite you to the show to share some knowledge with the viewers. Welcome, Jason.
Thank you. It's my pleasure to be here, and I hope I can offer some valuable insights on inflation, on monetary policy, on what the future will hold for most people, which is not going to be tremendously positive. But for the people listening and learning this stuff, I think their future is going to be very positive because they're going to learn how to take the lemons that were being offered, if you will, and turn them into lemonade.
Hopefully some cocktails as well.
Yeah, well, and maybe a lemon drop. How's that sound?
That sounds much better.
Good
Well,
stuff.
thank
Good
you
stuff.
for joining. Do you want to, so last time, I think on your channel, you showed a very nice presentation about your dollars are being debased and how to benefit from that. And I just found that it has so much good treasures of knowledge in there. Do you want to share some of that?
Sure, I will. And I'll also share my screen. For people listening on audio only, I'll try and make sure that, we're explaining all of this stuff so they don't have to see the visual. But if they want to, they can look at the visuals on all the usual places, YouTube, etc. So we all know that inflation is a real problem now. And frankly, this is not a new problem. This has been going on for decades. The inflation rate has always been much higher than we've been led to believe. The consumer price index, the most widely used measure of inflation, has been fake news for decades. Okay. It is just not an accurate measure of inflation. It's a basket of goods and they manipulate it constantly. They practice weighting, substitution, and hedonic indexing to make inflation look lower than it really is. However, right now, we are seeing extraordinarily high inflation from a historical level in the United States. In fact, the new numbers just came out today. This has always been kind of a boring thing that nobody paid much attention to. But now these inflation numbers are getting really scary. And we're looking at inflation by the official stats of around 7%. And there are multiple measures for this. And that's why I say around. But let's call it 7.2% on the official numbers. But the real numbers are more than double that, in my opinion. So people are experiencing in the cost of groceries, healthcare, school tuition, gasoline, inflation is just skyrocketing. Now, there's another manipulation they use, which is called core inflation or the core rate. You may have heard this term, the core rate or core inflation.
Right.
And what
Yeah.
that does is it takes the inflation index, but it strips out two things that they've decided are not that important because they're too volatile to measure. But interestingly, there are two things that no human being can live without: food and energy, because the cost of energy is in everything we buy. Okay. And of course, we all need food. So if you measure just core inflation, that's just at about 5% right now. Again, highly manipulated, and that's probably double to triple the rate they're quoting. So I don't think it's hard to convince people that inflation is much higher than we're being told. So that's where we are. The question is, what can we do about it? How do we deal with this problem? That's, I think, really the question for your listeners today.
Yeah, absolutely. Because everyone looks at this as a end of the world scenario. It's like there's nothing we can do about it. The animal is just too big for us. But you mentioned that we can actually take advantage of that. So yeah, I would love to hear what you have to say.
We can. So when you're in an inflationary environment, we've all heard and we know about the idea of going long on an investment. Usually this is used in the stock market. So most people buy long, right? They just buy a stock and they hope it'll go up in value. That's going long. But some people short the stock and they bet that the stock's going to go down. And so that's going short. So one thing I think we can all agree that we should be shorting is the US dollar, because the dollar is declining in value. And as the dollar declines in value, we want to ask, well, if we are pretty sure that it's going to decline and inflation is going to continue, then we want to take a short position on the dollar. And so in doing that, the question is, how do we do that? How do we short the dollar? Now, I like income property. I think income property is the most historically proven asset class in the world. And most people think income property or rental property is a great hedge against inflation. And they're right. But that's kind of a very basic understanding of it, because the typical understanding is, well, okay, I'm going to buy property and it will keep pace with inflation, or hopefully it'll exceed the rate of inflation because the property appreciates. But there's much more to that than meets the eye. Because when you place debt on a property, when you use a mortgage, when you borrow money, you're borrowing at interest rates that, for the first time in our lifetime, and probably the lifetime of anybody listening to this is a big deal what I'm about to say, folks. For the first time in probably anybody's lifetime listening, okay, the official inflation rate is now higher than the 30-year mortgage rate. That is incredible. It's incredibly good news, because that means we can borrow at around 3%. And they've told us officially the inflation rate is exceeding 7%. Now, in reality, the inflation rate's probably more than double that at about 14 or 15%. But officially, they're telling you today you can borrow money for 3 decades. If you borrow money today, you will not make the last payment on that mortgage until 2051. Just think about that. Okay. And you're borrowing at below the rate of the official inflation rate by less than half of the official inflation rate. So you're literally getting paid to borrow the money. Assuming you bought a property, got a 30-year mortgage, and kept the property vacant. And of course, there are some other costs, taxes, insurance, maintenance, but those aren't very big costs overall in comparison to the size of the investment. But, you would get paid to own that property if it were vacant or if you just lived in it. But if you rented it out, that becomes an extremely profitable investment. And that's why income property is the most historically proven asset class in the world.
If I may add to this great assessment, this is not available all around the world. So I come from Romania, and my sister is also buying or purchasing property, but having fixed rate for 30 years at such a low rate is just nowhere else but here in the United States, from my knowledge. When they have lower rates, it's usually just fixed for the first 2 years, first 5 years. And they calculate this. And so I think it's a great opportunity. I think that it has to do with we're in the center where the money is being printed, and not everyone is taking advantage of that.
Yeah, we are. So the U.S. coming out of the Great Depression in the 30s and the post-World War II baby boom era created some new entities, some government-sponsored entities: Fannie Mae, Freddie Mac, FHA, VA, and the USDA. And all of these agencies are basically subsidized by the government. So they are essentially a welfare program for homeowners, for home buyers, to encourage home ownership. But guess what? They also allow investors to use their money too. And so they're also a welfare program for investors. And, everybody listening here pays taxes, or has paid a lot of taxes in their lifetime, I'm sure. And you'd just be crazy not to get your government benefits. And so these are huge government benefits. So I created a strategy called inflation-induced debt destruction about 15 years ago or so. And I've been teaching this strategy for a long, long time to basically help people short the dollar and to get paid to borrow money. Now, historically, this opportunity has never been nearly as good as it is today, but in the past, it's been pretty good. But today it's even better, significantly better. So let's just go through the problem and some of the examples of how people can benefit. Remember, inflation-induced debt destruction. I know it's a mouthful, but it works beautifully. It's just a beautiful hidden strategy for creating wealth. So Janet Yellen and Joe Biden are the big spenders. Okay, they're running the spending essentially, and of course in Congress, the House Ways and Means Committee. But these are big spenders, and government spending creates massive inflationary pressure because the more government spends, it has to create fake money or fiat money out of thin air to pay for the spending programs, to pay for the welfare programs, to pay for the entitlement programs, to pay for all the things that get these politicians elected and keep them and getting them reelected. Okay, that's how they pay for it. So let's just look at 6 ways that I've identified many years ago for the government to get out of the mess it's in. The government has huge deficits, it has huge debts, and these are things it simply cannot mathematically repay. So the question is, what can it do? What are some possible solutions? Well, one thing it could do is it could just simply default. The government could say, look, I know we promised you Social Security. I know we promised you free healthcare. I know we promised you subsidized housing through FHA and VA and Fannie Mae and Freddie Mac. And I know we promised you disability payments. And I know we promised you, military that could defend the country, right? I know we promised you all of these things, but we can't afford it. We've overspent. So we're simply not going to offer these things anymore. And this would be huge austerity measures. And we saw in Europe, I was born in Europe too, we saw what happened in Europe when they instituted austerity measures, namely in Greece, but also Spain, Italy, England, Portugal. It's just all over, right?
All over, yeah.
Yeah. And so this is, and then the government owes a lot of debts, right? To foreign countries, to
IMF.
bondholders,
Yeah.
to treasury holders, et cetera. It could just default on those and say, look, I'm sorry, we can't pay our debts. It's tough luck, right? Very politically unpopular, very unlikely that it will have an outright default.
This also assumes that some politicians are honest, and which would not really happen. But yeah, go.
And that would be a faulty assumption. Yeah. The other thing it could do is raise taxes. Well, there's a lot of talk about raising taxes now, and I'm sure we will see taxes increase. But even if we taxed everybody at 100%, it wouldn't solve the problem. If the government just said, okay, as of tomorrow, everybody has to keep working like slaves, but we're not going to pay you anything. You're going to pay all of the money you earn, 100% of your income goes to the government. Well, think about that. The size of the GDP, the entire economy every year, is just over $20 trillion. Guess what? The problem the government has is over $220 trillion. So even if the government enslaved the entire population for 11 years, it could not, and not only that, and it stopped spending today, it could not solve the problem.
Imagine that.
Okay, this problem cannot be solved.
It's mind-boggling. Yeah,
it's impossible.
How indebted we are.
You cannot tax people enough to come anywhere near paying for the problem. The problem is so much bigger than taxation. Okay, it could have a yard sale. The government owns assets. Years ago, we talked about selling the ports to Dubai. Remember that? That was all over the news. The Bureau of Land Management sells off land to real estate developers and private companies sometimes. Sometimes we sell military equipment to countries that are not really our friends or later become our outright enemies. And we shouldn't be selling them military equipment, high-tech equipment. So these are all dysfunctional things of a desperate government. but it will happen. All of these things will happen to some degree, but the most likely one is about to come. Okay, we could use the US military to steal the assets of other countries. And if you think about it, this isn't any new idea. This is the history of the entire world. The world map was written by one country stealing the resources of another country. That's how we got borders in pretty much all cases. Okay, I mean there are a few exceptions, but mostly those were the way the borders were created. On the good side, the positive side, we could have some great technological innovation, biotechnology, energy, nanotechnology, whatever that solves all the world's problems and creates prosperity for all. Hey, that would be great. I'll take it. Let's hope that works out that way. But again, not likely. I think the most likely thing that will happen is what's been happening for decades. The government will simply inflate their way out of the problem. And the government is using my strategy, inflation-induced debt destruction. Because think about it. If the US government owes $1 trillion to China, for example, which it owes more than that, but let's just take $1 trillion because it's a nice round number. And the inflation rate is 10%. Now, that doesn't have to be in 1 year. Say it takes 2 years to have 10% inflation or 10 years, doesn't matter. Okay. But if the inflation rate is 10%, that means that the US government will pay China back in cheaper dollars. So it just got a $100 billion discount on its debt. Poof, magic, right? That is inflation-induced debt destruction. And that's the strategy the government has been implementing for decades. It's the strategy they're continuing to implement. And it's the same strategy I suggest all of us implement because it works. It is the beautiful hidden wealth creator that is not available in any other asset class except income property. It is unique to income property the way it's available here. So let's talk about why people should be excited about this, about the current terrible monetary and fiscal policy we have. To understand inflation, we need to distinguish between real and nominal. So the real value of something is, what is it worth? If $1 will buy me a certain thing at that time, I know what $1 is worth. But since the dollar's value is a moving target and keeps changing over time, I don't know what it's going to be worth tomorrow or next year. It's just impossible to tell. These are Zimbabwe dollars. Okay, these used to have real value. One of my listeners, my podcast listeners, sent these to me. This is 100 trillion Zimbabwe dollars. And it's worth nothing. It's just a collectible today, right? Because Zimbabwe debased the value of their dollars through spending and inflation and money printing. And that is exactly, to a lesser degree, what the United States is doing and what almost every country on earth is doing. When it comes to a country's currency, it's dollars or yen or rubles or pesos or Brazilian reals or euros or whatever, right? It is a race to the bottom to see who can debase their currency faster, right? And that's all it is. It's a comparison between these different currencies. So we need to understand the difference between real value and nominal value. Nominal simply means the name of something. That's the definition of nominal, in name only. So $1 today is called $1. But guess what? 50 years ago, $1 was also called $1. The name hasn't changed, but the value has certainly changed. Okay. Inflation is the insidious hidden tax that destroys our purchasing power. It destroys the value of savings, stocks, bonds, and even equity in real estate. But thankfully, it also destroys the value of debt. And that's why we have good debt and bad debt. So inflation is the most powerful way to redistribute wealth. Most people talk about taxation. You know, we're going to tax the rich and give to the poor. We're going to redistribute wealth. Well, sure, that could happen to some degree. The problem is that you put this agent in between that transaction called the government, and they take a huge handling fee off the top before redistributing the wealth. Okay.
It's also more visible and involves a lot of force, which
Yes.
people can fight against instead of inflation. It's a hidden tax that steals the value right out of your pocket. Yeah.
You are absolutely right. It is very, very visible, and people rally against it. They form political action committees against taxation. They do all this stuff because it's so visible. But guess what? Inflation isn't very visible. Yeah, people notice, gosh, the price of things is getting higher. It's harder to get by on my income. They think stuff like that, but they don't really get it. It's just not understood very well by people. Okay, so it redistributes wealth. How does it do that, though? And to whom does it do it? It redistributes wealth from lenders to borrowers. Why? Because when you borrow money, say you buy a piece of property, you buy a piece of property today. And by the way, this is what my company does. My real estate company helps people buy properties nationwide in good markets that we recommend. That's what we're in the business of. And so we teach people about real estate investing, and then we offer a referral network of properties they can actually buy. So say someone goes to jasonhartman.com, they pick out a property and they say, I like this property. I want to buy this property. And say that property is $200,000, or well, better yet, say it's $250,000, and they borrow $200,000 to finance it. Okay.
Right.
They will get the $200,000 today. And over the course of the next 3 decades, as inflation happens, they're going to literally be paying those dollars back in ever cheaper dollars that have depreciated in value. And that is a very good deal. That is inflation-induced debt destruction. So the borrower gets the value of the dollar today,
Right.
and the lender gets paid back in the value of the dollar tomorrow or over 30 years, right? And
Yep.
now you might think, well, why would a lender do that? Well, they charge an interest rate, and the interest rate is a very important item to consider, because the interest rate historically has been the fee the lender charges for the time value of money. And, when I was a kid, I used to watch a certain cartoon that taught me about inflation. And yeah, I'm not kidding, actually.
Imagine that.
And,
All
and
right.
this cartoon was Popeye. Do you remember Popeye, the
Yes.
cartoon?
I
Okay.
don't remember
Yeah.
inflation in Popeye other than eating
Well,
spinach.
Popeye taught kids about inflation
Okay.
because Popeye had a friend, and his friend was named Wimpy. And Wimpy used to
Right.
say, he had this famous saying. Wimpy would say, I'll gladly pay you Tuesday for a hamburger today.
Yes.
Okay.
Okay. The
And
hamburger
so
guy. Yeah.
Wimpy understood the time value of money, because he wanted the value of the hamburger today, and he wanted to pay back later.
Right.
And that is what inflation is all about, and how it enriches borrowers and impoverishes lenders. So someone might be saying, well, Jason, why would the lender agree to this? Well, historically, they had an interest rate that more accurately reflected the value of inflation and the time value of money. So they could cover for that difference. And it was some guessing game. It was some speculation. The lender might think inflation's not going to be that bad, and the borrower might think, hey, I need the money today, and inflation might be really bad, so I'm going to borrow the money. But what does the lender do once they make the loan? Well, they don't keep it on their books very often. Mostly they sell it off. And who do they sell it to? They sell it to Fannie Mae and Freddie Mac. And, if you look at it, in any deal that you make, the biggest loser in any deal, the willing loser, is always the government.
Right. Yeah.
Okay? Because the government doesn't play by the same rules that the rest of us play by. They live in a fake economy, and especially a government that has the biggest military the human race has ever known and the reserve currency of the entire planet. all international trade needs to take place in US dollars. Now, granted, there are some defectors that go outside of the system, but
It's happening more often now.
somehow we always end up invading those countries. It's just funny how that happens.
Yeah.
Okay. It's, it's just a coincidence, I guess.
Yeah, the chain is quite long because you said the government is the loser, but actually the government is quote unquote us, right? So we are the losers. Whenever a mortgage gets bought off by government, that is eventually distributed and everybody else actually bought that. So when you're purchasing something, I mean, there has to be a loser, but I think it's always written off eventually on the people by devaluing their currency, right?
You
Because
got it. Yeah. Most people, by
when
the way,
I'm
yeah,
because when I'm purchasing a property, that money is actually being sort of printed, right?
Mhm.
It's being issued with fresh money, like how the currency supply grows. So actually, when I buy a property, eventually that loss is transferred to everyone else who did not buy a property.
You know what? You have a good understanding of this, but most people do not have a good understanding of this. So most people think, well, if the government loses, then taxpayers have to pay. And that's simply not true. Taxpayers might pay a little bit, but they don't pay much. The real people that pay is everybody who has savings, stocks, bonds, mutual funds, and all of this currency units that get debased
Yes.
and devalued. And the winners are the people who have long-term fixed rate cheap debt.
Mm-hmm.
So the question is, how can we do this and what's a specific example of it? So one of the things I've noticed throughout the years that's a very ugly thing is this. And so I came up with this quote: when the government is broke, it becomes predatory on its citizens. And it taxes people through tax, but also through the inflation tax, the hidden tax. Okay, let's take a real life example. How do we really use the stuff we've learned today? Let's go back to 1972. And let's say, and by the way, this is not a theory. This actually happened to tens of millions of people. And around the world, maybe over 1 billion people. Nobody knows the exact number, but it happened that way because people did multiple transactions in different years. Okay, that's how it happened. But let me just give you an example of, maybe 1 million people who did exactly what I'm about to say. In 1972, they bought a house. And when they bought that house, they borrowed money to buy that house. When they bought it, the dollar was worth $1 because no time had passed, no inflation had passed yet. Well, guess what? 12 years later, that same dollar was only worth 40 cents. Yet it's still called a dollar, but there's been a 60% discount on it through inflation. That's how much inflation tax there was in 12 years. 60%. It's a huge number. Okay. By the end of this mortgage, as it's nearing the end, 30 years later in 2001, that dollar was now only worth 24 cents. So a 76% tax on the dollar. Okay. Well, what does that really mean? Let's analyze it. In 1972, if they wanted to get a mortgage, they would have to pay 7.37%. That was the interest rate back then on a 30-year mortgage. Okay. After inflation devalued the money they're paying back on that mortgage, and these are people living in the house, by the way. This is not an investor. It's a homeowner, an owner-occupant. By the time inflation devalued the payback of the dollars, they only paid back a real interest rate of 1.06%. 1.06. So their interest rate was a lot lower than they thought. That's good. Okay, good so far. But wait, there's more. Because when you borrow money, back then or now, the government becomes your partner in the borrowing. And they say, okay, you know what? You're paying interest on that loan at 7.37%. We're going to allow you to deduct your mortgage interest on your tax return.
Right. Yeah.
So it gets better. Now, also notice something. The government calculates the interest based on the nominal interest rate, 7.37%. They don't consider inflation. The tax code does not understand inflation, which is interesting. Now, this benefits us in this example, but in some ways it hurts us. Let me give you an example of that. So this a little tangent for a moment. The subject of tax brackets, right? Everybody, has a certain tax bracket they pay in because we have this progressive tax system, which is not the right word, but that's what they call it. So if you're at the highest tax bracket, you're earning a high income. And if you're at the lowest tax bracket, you're earning a low income, so you pay a lower percentage. Well, guess what? If inflation comes along and you get a cost of living increase in your income, but you're paying more for everything, so it wasn't really any increase, it was just a sham, right? Even though they don't raise taxes, say they didn't raise taxes, it could kick you into a higher tax bracket.
Yes.
So you're going to pay at a higher rate.
Correct.
So the government not understanding inflation actually hurts you. But in this example with the borrowing, it helps you. Okay.
Right.
In real interest after inflation, we only paid 1.06%. But after the interest deduction on that mortgage, we got paid to borrow the money. Negative interest rate of 1.16%. Literally paid to borrow the money. This is why the millions of people who bought homes became so much richer. The average net worth of a homeowner, even if they're not an investor, is dramatically higher than the average net worth of a renter. Now, it's not just because of this, because, the homeowner might be a higher income earner to start with, a more responsible person to start with. Sure, all of that is probably true. But they certainly got a lot of help by inflation-induced debt destruction. Okay, now let's analyze it. So the average price home back then was about $18,000. If they borrowed 80%, they got a $14,000 and change mortgage. In nominal dollars, they repaid $36,000 and change. In real dollars, they only repaid, and they thought their interest rate was 7.37%. In real dollars, they only repaid just over $16,000, making their effective interest rate 1.06%. After tax dollars, because they got that tax deduction, they only repaid $12,600 and change, making their interest rate negative 1.16%. This is an incredible thing, and it's called inflation-induced debt destruction. I gave it that name many years ago because that's what it is.
It could be one long Hungarian word, by the way.
Oh, would it really? Yeah.
Or
yeah.
German, yeah, they put together words. I just want to hold this thought. So if effectively the interest rate doesn't really matter. What matters is the difference between the inflation and the interest rate, that whether you're getting a positive or negative return, added the tax benefits you get with this. So that's quite interesting. And also on tax brackets, I had, because you were saying that the government or the tax offices don't understand inflation or the tax law. I think there's a bit
and by the way,
different than
I'm
that.
sure they know what inflation is.
No,
they
no,
may
I know
intentionally
what you
not
meant, of
understand
course.
it, just so you know. Okay.
But it was, yes, of course, I know what
Right.
you meant. But there's also something nefarious in that, because now if you want to raise the taxes on the rich, you don't even have the concept, but eventually with inflation, you will reach that bracket without getting any richer in real terms, and you're actually voting for yourself to be taxed at those high rates. Because when inflation gets really out of hand, in case of Romania or some of those countries, you get to be on the high brackets very soon, because it's a case of doublings. If with 7%, it doubles every 10 years, right? With 20%, that it doubles in 5 years, right?
So that's called the rule of 72s. Yeah, very good. Yeah.
So just wanted to add that they are quite, there's a hidden secret in there that you don't know about, that you will get to eat the policies that you want to make to the rich eventually yourself.
Yeah, I agree. I know. It's really something, but that's the way people can take advantage of inflation-induced debt destruction is to go out and acquire a whole, I call this the ultimate investing equation. That's another one of my teachings, but we don't have time to do that today, but there's lots more information on my podcast, The Creating Wealth Show, and on my YouTube channel and at jasonhartman.com. But basically, part of the ultimate investing equation is this. Think about it. You go out and you acquire assets with 80% of somebody else's money, the bank's money, and then you say, well, now I got to pay that mortgage back. I don't like paying the mortgage back, so I'm going to delegate that responsibility to a tenant. And I'm not only going to ask them to pay the mortgage payment, I'm going to ask them to pay me a little extra every month, maybe $200 extra per month on each house. That's called positive cash flow. And then I'm going to say, gosh, I'm getting richer and richer, and I don't like paying taxes. So I'm going to depreciate the property because properties are depreciable. Now, you got to check with your accountant on the way all this stuff works. Everybody's situation is different. Blah, 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 disclaimer. Okay. So yada, yada, yada. And so then you get this incredible tax benefit. The asset should be indexed to inflation pretty well. Maybe it'll even beat inflation. Inflation goes up, house prices go up, right? But the thing that happens in the background is the cost of the debt declines so fast, and you're beating inflation with leverage because you've basically got like a 5-to-1 ratio there, okay?
Right.
Where you've only got 20% of the money in the deal, and over time, as the property appreciates, you'll have even more in the deal, but you want to do equity stripping and refi that equity out. So you keep your equity percentage very lean, and you get as much leverage as possible and as much inflation-induced debt destruction as possible.
Yeah, that's quite interesting. So regarding taxes and how to depreciate, of course, I'm not a tax lawyer or attorney, but it does kind of show you that the tax laws need to be read as a guidebook, really, like what the government is incentivizing you to do and how to invest, basically, instead of viewing it all the wrong way. So if this is in there, that means the government actually wants you to create wealth and generate, real estate and build, and well, you're making the country richer anyway. So.
Yeah, look, I mean, the government is incentivizing investors to provide rental housing.
Right.
And so do what the government wants you to do. I mean, do what they're incentivizing you to do. That's the only thing to do is take advantage of the laws. They're giving you a gift. And people that don't take advantage of it are just missing out. So don't miss out.
Yeah. So by taking advantage, actually you're doing what they want. That is exactly what they want, right?
Yeah.
That's
absolutely.
what they are incentivizing.
They're giving you huge tax benefits and also mortgage benefits to provide rental housing. So keep doing it or do more of it. That's exactly what you should do. And the place you should start is jasonhartman.com. So there's a shameless promotion there.
Great. Thank you very much. So I will have a link to your website and your YouTube channel in there. I do have a couple of questions, if you don't mind. Just that would hopefully clear to our viewers, but me as well. So you talk about in your presentations about cyclical and linear markets.
Right.
Can you talk a little bit about the differences between those two, and what do you recommend actually?
Sure. Yeah, absolutely. So let me just pull up some visual aids here. Can you see the slides?
Not yet.
Oh, sorry. Can you see it now?
Yes. Perfect. Okay. Thank you.
So linear, steady and profitable markets. So if you're looking at a chart or a graph, it just kind of chugs along and does its thing. There's appreciation, but it's slow and steady. There's some bouts of depreciation, but they're not as pronounced. Cyclical markets are like a roller coaster. They go up, they go down. Really significant changes in prices in those markets. Hybrid markets are in between the two. Let me give you a couple examples. This is Memphis, Tennessee, right? Yes. Memphis has been a really big market for us for many years. This is a linear market. And if you see the chart, with the red arrow that I put here, it's just very steady. It has some ups, it has some downs, it has ups, it has downs, sure, but they are nothing like a cyclical market like Miami. I live just north of Miami, and if you plot this, you've got really big ups and really ugly lows, and this kind of roller coaster effect. Now, I'm going to give you an even more pronounced comparison here. This is Indianapolis, another market that we've recommended for many years, and it's a very linear market. It just kind of chugs along and does its things. It has some ups, some downs, no big deal, right? But compare it to where I grew up, Los Angeles.
Right.
I mean, this looks like when there's an earthquake in LA, it looks like looking at the Richter scale. It's really jagged, up and down, up and down, up and down. So that's the difference. We recommend linear markets because not only is over time the pricing relationship better, because in the downtimes, you're not giving back a bunch of your gains. Remember, think of it this way, and this example is commonly used for stock market investors. If you buy a stock and it's $50 and it doubles in value and it goes to $100, right? To get from 50 to 100, you had to gain 100%. But if it's 100 and it goes to 50, you lost 50%. But to get back, you have to gain 100% again, right? That's the problem with cyclical markets. During the bad times, you give back so much that it's hard to recover from that. But regardless of appreciation, the cash flow is so much better and the landlord friendliness is so much better, meaning that the laws, the regulations are friendly to landlords more than they are to tenants. In cyclical markets, almost invariably, they're very tenant friendly. And if you have to evict a tenant from a house because they're not paying you, you're like the big evil landlord. And the courts and the whole system just hurts the landlord because they think you're they think you're Donald Trump. There's an example. You can't use that example the way you used to,
Right now it's a different.
Yeah. Yeah, everybody has different feelings about that word nowadays. But I hope that explains the linear, cyclical, and hybrid market.
Yes, for sure. And it does tell you like you can lose so much on a downturn that
Yeah.
you have to make so much more in order to get back where you were. Now you mentioned landlord friendliness, and in some of your videos you mentioned that it would be better to self-manage the property.
Oh yeah.
Can you talk about why do you think that is better?
That's a long topic, right? That we could talk about for quite a while. But basically, most of our clients use property managers. However, we about 12 years ago, I really started teaching a lot of people how to self-manage properties from a long distance, and it actually works quite well. A lot better than having a manager many times. So for those who want to, we offer a community and a group that really focuses on teaching that. It's called the Empowered Investor Inner Circle. And they can find out more at empoweredinvestor.com, where they can gain more control of their investments and, really have just a better experience, higher return on investment, and self-manage if they want to.
Yes, it doesn't even compare to owning a stock or a bond or something where you have completely no control over what happens. But if you have own real estate and self-manage, you have a lot of control on how that asset will perform just by managing it, choosing the right places, getting all the knowledge from jasonhartman.com and his podcast, which is awesome.
Yes, absolutely.
So one more question. So if I look at charts, of course, when I look at them, it always seems to be that everything, but including the real estate market as is kind of the top of the market today. But you tend to have a different opinion, and I like how you explained that is real estate expensive or is real estate cheap today?
Yeah. So I created an index, and that would be a whole nother show we'd have to do to talk about it, but it's called the Hartman Comparison Index, or the
Yes.
HCI. And anybody can go to jasonhartman.com, just get on our mailing list anywhere, and we will send you the white paper. It's about 17 pages long. It goes through the historical aspect of the real estate market and a bunch of other markets for commodities and so forth. And it really shows you that real estate today is much cheaper than people think it is. So, when you compare it to other things
Right.
and you answer the question that I think is life's most important question, and that is compared to what, um, that then you really find that real estate is actually quite cheap. And maybe we can do another show on that someday. But
Definitely, I
I've
would be
got a
really
bunch of
interested.
videos on my YouTube channel about that, and podcast episodes about that too.
Perfect. Well, thank you very much, everyone. Jason Hartman, link to his website and to his YouTube channel will be in the description. Jason, thank you very much for joining the channel.
All right. Thank you for having me, and happy investing to everybody.